So welcome to another video. My name is Robin, and as per usual, I'm joined by Kirill. And today we're gonna discuss what the elections are probably gonna do for the stock market and for the U.S. economy as a whole. Of course, it's an interesting topic, considering that in a couple of months the U.S. will go to the polls, and yeah, they will choose a new leader, and that will have impact not only for the U.S. of course, but also on the rest of the world. So with that said, let's get into it, Kirill.
Yes, sir. Yeah. The whole reason why we also decided to pick up this topic is, of course, the volatility on the S&P. In the past, months, especially like in the beginning of October, you could see quite a big dip, right? And now it's also feeling a little bit shaky, let's say. So what we also wanted to share with you guys, let's say our thoughts and opinions and a little bit of statistics of how do stocks and S&P 500 specifically usually performs during the times of volatility, and for example, how can you also adjust your, for example, actions when it gets to your investments. So without further ado, let's get started. And basically, if we jump into the statistics a little bit, we can see that on average, S&P gains around 7% during the presidential election years since 1952. However, it's quite drastically different from the average of 17% of the returns of prior to the election year. So it means that there's less volatility before the election year, and then quite a lot of it, let's say, during the election year. So it's also something for us to keep in mind, that we have already seen something like that already going on in August, right? Which also kind of correlates with the statistics. When it gets to, for example, the election results and how do they react to the stock market, depending on who is winning, from the Morgan Stanley mini research paper, as we could find, when a Republican president is elected, then the average return of S&P is around 15%, which is quite a big of a difference in comparison to when a Democrat usually is elected, and it's a little bit below than the average of all election years, of 11%. So if, for example, our lovely gentlemen from Democratic Party are going to win, maybe we can expect a little bit more influence on the broader market, because we are also aiming to, for example, cool down a bit the big corporate guns, of the United States. So impose more taxes on them, and make them just experience more, legal scrutiny, as well as we can already see, like, for example, what Biden was also saying, like, in terms of increasing the corporate taxes, increasing the share buyback taxes, and so on and so forth. So would it be good for the broader S&P? Probably not. So that's why also what we've been discussing last time, Warren Buffett started selling his stocks, and doing the share buybacks of Berkshire as much as possible, because then you could get taxed quite heavily on that. So yeah, better be careful. Better be quite careful on that. Also, what's good to keep in mind, statistically, according to the National Bureau of Economic Research, it has been observed that in 54%, so a little bit more than a half, in the 12-month period of the election times, it has these time frames have overlapped with the officially stated U.S. recessions. So when the government actually comes out and says, "Yeah, okay, guys, we're in a recession period," so that's even more of troubling news upcoming for us potentially, even though we have already talked with Robin about the fact that, yeah, the macroeconomic situation doesn't look any good, even though they don't officially call out the recession. It could, even if it's not going to be officially announced or not, we can already see that, something cheeky is coming up, and again, something for you guys to prepare for, maybe potentially, in terms of your investments or hedges against inflation, against the stock market potentially dropping. So again, another aspect of saying be careful.
It's also most of the time there's also like these big booms and busts because people are really excited about the new president or uh, you know uh, or someone not winning, let's say. But then after a while, you can also see that these expectations are not met, and then it slows down, and then you have these kinds of things running in.
Yeah, absolutely. And especially I remember the times when Biden just got into the Oval Office and he was like saying that we're going to support the green energy, sustainability kind of initiatives, and then they would like provide quite good benefits and subsidies. And I remember the stocks that are related to the green energy, they just skyrocketed, and now they're on rock bottom.
Yeah.
So sometimes also, guys, keep in mind that the promises of the politicians are not necessarily gonna, provide any good results. Something also for you to keep in mind and do your due diligence, as we always say. So yeah, yeah. So shall we look into, for example, what our upcoming elects are gonna
Yeah. Let's
propose?
let's start with Kamala.
Yeah,
So her plans are mainly to fuel the U.S. economy by increasing the amount of startups on the playing field, which is of course a good thing. But we also have to consider that a lot of startups do not make it. And then on the other hand, she really wants to continue Biden's plan increasing the corporate tax rate, which is not really interesting, of course, for established businesses. So, for example, in the Netherlands, we had this thing where the dividend tax got increased, and we lost a lot of companies that were headquartered in the Netherlands. So, is there something that could also happen here in the US? Like, if the taxes are getting out of hand or increased by a lot, especially if it's about tons of money, are they going to stay in the US? Or are they going to go elsewhere? And what's that? Yeah, how is it going to affect the US economy and the economy as a whole?
yeah, exactly. Yeah,
That's something that we should consider with her. And then what you also mentioned, Kirill, is the increase in the share tax on share buybacks,
yeah,
which
yes.
is
So
fueling the
basically,
growth for the stock markets as well, right?
Exactly. So yeah, as it says here, I just already pulled it up. So as a part of the Inflation Reduction Act of 2022, so Biden administration proposed to impose at least 1% tax on the share buybacks. Which, for example, yeah, if you already look at, for example, Nvidia recently announcing a 15 billion share buyback, you can already understand how much it is. But then what we also say that they'll push it even higher to around 4.6%. So that's quite hefty. And if you consider that, like, yeah, the big giants like the FANG stocks, their share increase in price is mainly fueled by share buybacks, that's going to be tough because they will not be willing to give up quite some money if they're doing the share buybacks in billions, not millions but billions of dollars. And yeah, it's quite heavy. So you might experience as a stock owner, I don't know, of Tesla, Nvidia, or Apple, that it can probably go down if they're gonna cancel their share buybacks programs or if they're gonna reduce them. So
Yeah. Yeah, of course, like if the float, doesn't really decrease in amount of shares outstanding, yeah, then just regular, um, yeah, demand and, supply for these shares, if they just remain constant, then yeah, you will see a decrease
yeah,
in share prices.
yeah,
So that's indeed something to consider here. And then we can also go over to our boy Trump, and he has some other plans for the economy. So he mainly wants to focus on industry, right? So he wants to keep a lot of the production facilities inside of the US. He also wants to make sure that the big corporations have less taxation so that they can do more business in the US. And that's mainly for businesses that are also producing mainly in the US. So he's trying to really, full circle the economy around the United States. And I think for the S&P, this will be more beneficial.
yeah. True. And I think also the good part about it, of course, is that it's gonna also even attract the companies outside of US, right? For example, I've heard that. Well, of course, the cheap manufacturing companies are gonna go and move to US, especially like, for example, the big one is TSMC, right? But also, for example, I heard rumors about Volkswagen aiming to move its production facilities also to US because of, the energy bills and the cost of labor in Germany is sky high. So it's kind of a good thing that if US would be able to attract the European-based companies over to North America. That's going to be beneficial for them. Of course, it also could hurt the aspect of the corporate debt. No, sorry, not the corporate, governmental debt. in the US, because, well, the thing why Kamala Harris and Joe Biden were pushing to increase the taxes, right, is just to cover up the piling up debt, right, which is trillions and trillions of dollars, as Trump likes to put it, right. So there's got to be a way where the government will have some additional source of income. Otherwise, it's not sustainable at all to keep on piling up on that debt, and especially when the interest rates are going to be reduced, right? It's what's the point of having U.S. bonds if it's like, okay, 1% return a year? I don't think it's lucrative at all, So you can find some better sources of income when it gets to that. So yeah, it could be, both could be good, both could be bad, depending on the, let's say, the perspective in terms of the horizon, right? If you're thinking long term, maybe raising taxes is a good idea, of course, right? But yeah, you also need to kind of support your economy in the short term, because the not so good results in terms of the unemployment rates. Let's actually check it, because let's just open up our macroeconomic dashboard, and we can just briefly go through these in graphs, right, in the official graphs. Also keep in mind the sources of these graphs are TradingView, and they also get their data from quite reliable sources. So trustworthy, let's put it like that, trustworthy. So as you can see, for example, in the government debt to GDP ratio, so it's quite high. It's 120%. So when it looks red in our app, that's definitely bad. When it's green, that's good. So it's also something for you guys that you can easily differentiate that. The higher this number is, the worse it is, because then your government is ineffective, and then you actually need to either reduce down your costs or grow your GDP and actually create more work, create more services, create more products, output, whatever. GDP growth, it's, let's say, more or less on par with the inflation, right? It's nothing outstanding in here either. And especially it's way better than back in the COVID times. So it kind of reverted, but of course it could be better. That's why it's also something to keep in mind. If for example during the Trump administration they'll be able to bring new businesses to the US, it might fuel up the GDP, of course, and that's going to be beneficial probably for everyone globally. Something what we also discuss in terms of the funds rate, federal funds rate, by the times when the Fed starts lowering it down, S&P usually also goes down with it as well, because of the expenses associated with borrowing money. So also for you guys to keep in mind, probably in short term it's gonna hurt us, at least I mean us investors in S&P. But then the good thing is, at least with the high interest rates, inflation is also going down. If we, for example, compare it to the other years prior to COVID, right, it was around 1%, the high was 3% in 2018, right? Now, even though the inflation went down, it's still not as even close to be low as it was before COVID times. So let's say the US government is doing good, and the Fed is also doing good in terms of lowering it down, but it has way more options to be even lowered further, because 3% annually, it's going to compound, and it's going to also hurt the consumers as well. And also lastly, I think what we just discussed about the prospects of bringing more businesses to US, the PMI index, so it's for services and for manufacturing. So these indexes, they measure, let's say, the environment and how healthy it is for the businesses to operate in the country. And as we can see, 48 is pretty low. It's out of 100 usually. So what it means is that the manufacturing companies are not doing so well nowadays in US, and I think the threshold is around 50 when it can be said that it's more or less balanced. Above 50, it's going good, So the only thing that keeps, let's say, the United States economy right now is not the manufacturing side; it's the services. But the problem with services is the inflation, because you can put any kind of price tag on the service that you want, but with the manufacturing side of things, you got thinner margins, and it's highly dependent on the cost of resources, cost of labor, cost of energy to produce things, etc., etc. So, yeah, I think with that said, what can we conclude here?
Yeah, well, there are some good and bad things, if, of course, for both candidates. But yeah, I, from my perspective, I think the economic plan of Trump is gonna at least be more beneficial to investors, which you would also expect, of course, right? Because Republicans are mainly about free market, whereas the Democrats are more controlled. So there's no surprises there. But we have to keep a close eye on how the elections will turn out, and of course how well they can keep their promises.
Yeah.
Is there anything you want to add to that, Krill?
Maybe just one thing, let's put it like that. Short term, for you guys, what you got to keep in mind is that make sure you also adjust your portfolios accordingly. If you have seen, like, for example, so much volatility that can happen and the negative returns of S&P, better maybe prepare for a hedge. So that's what we also do with Robin. So for example, we to be honest shorted S&P a while ago, and I've also bought some long-term treasuries just to play out the bet on the decreasing interest rates, because it has to happen, otherwise the economy is not going to survive. But you can also get something more traditional, like for example gold, or something like very stable companies such as maybe Coca-Cola or something like that. These companies are definitely not going to deteriorate in terms of the share price, because, well, it's quite, Coca-Cola is kind of like gold of stocks. Or you just gotta pile up on cash a little bit, and that's what we have seen, for example, Warren Buffett is doing, right? So they're just waiting for something to happen, and if these kind of guys are waiting, then most likely something will happen. We just don't know what it is or when it will be. So it's just important to be ready for this kind of things. Yeah.
Exactly. We never know. But the only thing that you can do is, of course, prepare. And that's also what we've been seeing, of course, lately, is that almost all companies that we evaluate are overpriced. So at one point, there is something bound to happen as a correction, maybe, or whatever. But something indeed needs to happen. And the only thing that you can do is hedge against it. But I think with that said, we can wrap this one up. So I would like to thank you for your attention. Thank you, Kirill, for being here. And of course, we will start launching our app soon. So make sure to follow us on social media. And with that said, have a good one. Chippy, chippy, choppa, choppa.
We're ready, boy.